G'day guys, it's Nathan here. Today, we're going to discuss the surge in interest rates. And as a mortgage broker, I'm going to share my thoughts and predictions for the second half of 2023. We're also going to look at the forecasts of Australia's major banks and an independent macro strategist who looked at a sophisticated economic modeling with bold predictions. Now, let's look at the forecast for the second half of 2023. And there is a lot of if, buts, and maybes. And with economic factors galore, which could affect interest rates, we're going to try and give you the best insights available. We're going to look at not only what experts are predicting, we're also going to provide insights at the end of the video that'll help first home buyers who are looking to get into the market for the first time and how they can cope with the uncertainty they're facing. Let's start off with the bank predictions, and ANZ predicts that the current 4.1% cash rate may not be adequate to get inflation in line with the Reserve Bank's goals. The bank suggests that there's going to be another 25 percentage point increase in the cash rate, which is 0.25, which would push the official cash rate to 4.35%. According to the ANZ, they foresee rate cuts might not eventuate until November of 2024. Moving on to Commonwealth Bank, they predict that there might just be one more 25 basis point hike in July or August of this year, taking the official cash rate to 4.35, in line with ANZ's views. And the bank also suggests that there is a possible scenario of 2 consecutive rate rises in July and August combined, which would drive the cash rate to a peak of 4.6%. National Australia Bank aligns with the two other banks, suggesting that there's likely to be only one more 25 basis point increase in either July or August, which would take the official cash rate to 4.35, where they see it peaking out. They predict that these are challenging times due to mixed messages from the Reserve Bank throughout 2023, which makes it even more challenging for them to foresee where the rates are going to land. Similarly, Westpac sees a potential 25 basis point increase in July, which would make the 4.35% cash rate its peak, and the bank expects that by August there could be sufficient signs that inflation is slowing down for the Reserve Bank to maintain their rate. And stick around because we will run through the independent macro strategist analysis soon. Now, I guess the Reserve Bank has reiterated its goal to bring inflation back within its target range, and Governor Philip Lowe emphasises that the bank is committed to curtailing inflation. High inflation, if allowed to solidify in the public sentiment, would demand higher interest rate increases and would more or less increase unemployment to combat inflationary pressures, stated by the Reserve Bank Governor. The Reserve Bank is committed to restoring inflation back down to its target of 2 to 3% while ensuring economic stability. Now, the next cash rate is due to happen on the 1st of July, or the first Tuesday of July, and the Reserve Bank meets up every month excluding January, and the release of the recent jobs data has caused bond markets to swiftly reassess the likelihood of the Reserve Bank increasing the cash rate in its July meeting. It's actually pushed up the probability of a higher interest rate, moving the cash rate from 4.1 to 4.35%, and traders are now perceiving a 64% chance likelihood of this increase happening, which is a significant increase from the previous 36% before the jobs figures were released. Now, my personal opinion on the big bank economist prediction of the cash rate is that we've found that their expected peak in the cash rate has continually changed, and it's fairly difficult to try and predict accurately where things are going to land. We are finding that their prediction is always changing, and we've seen with unemployment levels remaining at historic lows, inflation proving stickier than anticipated, it certainly makes it a real challenge for the banks and economists to accurately predict. And even the Reserve Bank themselves anticipated that there would be no change to the cash rate in 2024, and look how that worked out. So I guess it is complicated to try and really predict where rates are going to land. And even with the banks, with massive amounts of data available to them, deep pockets with their own research and economists have consistently predicted the peak cash rate incorrectly, and we can even see the Reserve Bank themselves got it wrong. So it is really difficult to know where things are going to land, and that's where we're going to look at this independent macroeconomist who has actually looked into some of the details and gives us some good insights now. I guess before we go through that, if you do find value in our videos, please consider hitting that subscribe button, as it really does help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content. We hope you enjoy. On the 9th of December 2021, Coolabah's in-house research team turned heads with bold forecasts on the future trajectory of the Reserve Bank's interest rate cash rate. Kieran Davies, the chief macro strategist, suggested an upcoming surge in interest rates higher than what was anticipated by the Reserve Bank or other market participants at the time. Davies' data indicated that there'd be a likely spike in demand-led inflation, which was going to be fueled by unusually robust wages growth. And the Reserve Bank had stated at the time that the neutral cash rate, the cash rate in which neither is expandatory nor contractory, at that stage was at least 2.5%. However, Davies, the research head, suggested that the actual neutral rate at the time was going to be between 3.5% to 4%. As per the Reserve Bank's own modelling, he said. This finding was later backed by the central bank's internal modelling, revealing that a 3.8% rate would be needed to reach the neutral rate. In his presentation, Davies calculated that level of unemployment consistent with stable inflation within the Reserve Bank's target of 2 to 3%, known as the non-accelerating inflation rate of employment. Contrary to the Reserve Bank's claims of the low 4%, Davies' model suggested that it was actually between 5 to 5.5%. This result indicated in a hot labour market with significant potential for wage growth. Davies dropped a bombshell when he revealed where the Reserve Bank's cash rate might need to go in order to control forecasted inflation. Contrary to financial market predictions of a peak rate of less than 2% by 2024, back in 2021, Davies' data really concluded that the Reserve Bank would need to elevate the cash rate between 4.6% and 5.6%, and this was a significantly higher estimation than the mainstream forecasts. And stay tuned, because we will give you 3 practical tips, especially if you're a first homeowner looking to get into the market with all this interest rate uncertainty a little bit later. And with the big bank predictions, the cash rate in their mind is only going to peak around 4.35 to 4.6. And we can see Davies' analysis pointing that the cash rate might actually need to hit 5.6, which is certainly turned a lot of heads. As of now, the cash rate has climbed from 0.1% to 4.1%, and Reserve Bank of Australia has recently revealed its indications that it may need to increase the cash rate to 4.8% to bring core inflation down to 2.5% by June 2025. Recent data points towards a wage price spiral, as evidenced by an 8% increase in unit labour costs over the past year, ending March 2023. This massive inflation of labour costs is linked with the worst labour productivity seen since World War II, caused by factors like underinvestment in technology, unskilled workers, and complacency due to years of prosperity. As per Davies' research, the Reserve Bank continues to increase its cash rate and is likely going to need to get to the high 4s to low 5s to manage inflation. This increase could pose significant challenges for risk-prone businesses and households who have borrowed money expecting low interest rates. According to estimates, a 4.6% cash rate could lead to a negative cash flow for 19% of household borrowers and 80% reduction in free-flowing cash flow for 28% of households. So it's interesting to see Kieran Davies with such a different view from the big bank economist predictions. And I guess we're only going to know who's right when we look back in hindsight. Stay tuned, because we're going to go through the 3 tips we talked about a little bit earlier for first homeowners in a minute. What we do know, with the poorest labour productivity that Australia has experienced since World War II, central banks will have to go high with the cash rate in the short term. And this is where, if you're looking to get into the market for the first time, understanding where the market's going is super important. And today we've talked about rates and the fact that they're looking to go up in the short term. Many first homeowners are probably worried about where things are heading and the uncertainty. So let's run through 3 practical tips that will help if you're looking to get into the market for the first time and you're wanting to get some certainty. My first tip is the mock mortgage. This is a simple one. but it'll give you heaps of confidence. A mock mortgage, or a mortgage on training wheels that some might think of it as, is really a simulated mortgage repayments. It'll allow you to implement what your repayments will be based on your estimated mortgage repayments for your ideal home. Say, for example, you have a budget and the estimated mortgage you're going to need is about a $500,000 mortgage once you put your deposit down and you've covered all the costs. What you can do with a mock mortgage or a mortgage on training wheels is estimate what your monthly repayments would be on that $500,000 mortgage at, say, an elevated interest rate, so you can get some comfort in knowing that if rates do go up, you know what you're up for. So currently rates are around the 5.5%. It makes sense when you do your mortgage on training wheels or your mock mortgage to adopt an interest rate of 7%, given we know rates are going to go up, and you want to make sure that you're conservative and you can calculate where your repayments are going to be in future circumstances. So let's say on a $500,000 mortgage with a 7% interest rate, your mortgage repayments per month are going to be about $3,300. Now, you can make up the difference between what you're currently paying in rent. So let's say you're paying only $1,000 per month in rent, and the difference between the repayment. So that would mean that you need to put away $2,300 on top of your rent in a savings account or somewhere consistently, so that you can get a feel of what the mortgage repayments would be like and how you'd cope, especially if you have a breakdown in your car, you've got an unexpected insurance payment coming up each month. You know if you can handle it and what that's going to feel like. And once you've done the mock mortgage, it'll really give you a good feeling on what you're likely to be encountering with the mortgage. I'm going to leave a link in the description below to a mortgage repayment calculator that's on our website to help you calculate your repayments. Also, when you're playing around with the calculator, you can look at the repayments, what they'd look like if rates did come down, say at 3%. Or a 4% rate, or even if rates elevated to an 8% rate, you can look at so many different scenarios and get comfort around what it looks like. So the first tip is a mock mortgage or a mortgage on training wheels. It'll definitely help you feeling confident. The second is to have a savings buffer. So this is something you can do as a first homeowner by looking to retain some of your savings as a buffer post-purchase. Now, there are a bunch of first home buyer options available out there, such as lending up to 95% of the property value with no mortgage insurance. And this is where, if possible, when you go to purchase, you might decide not to utilize all your deposit, meaning you can have a bit of a safety net available to insulate you against any unexpected costs or rate increases that might pop up. You do need to be careful here when you're retaining a buffer, because in some instances where, say, for example, you're paying lender's mortgage insurance, it can be more costly to put down less of a deposit. And this is where working with a mortgage broker like ourselves, we can show you what this means for you in real terms so you can make an informed decision. Which means in circumstances where retaining a buffer is going to be very costly, it might not make sense. So it's one of those situations, it's more of a case by case, and it depends on your individual situation to really take into account before making a decision. Having said that, this is one that'll give you real confidence in a rising rate environment to make sure you've got a little bit of a buffer. The third and final tip is looking to fix in your loan. Now, this is another one that'll give you confidence around your repayments in an interest rate increasing environment. You can actually lock in your fixed rate from 1 to 5 years, and rates change depending on the fixed term you go for. As we've talked about earlier, no one's got the crystal ball. So when you lock in your rate, it could potentially come down when you're in the locked period. No one knows. You've got to be careful because there are rate penalties for breaking out of that fixed rate earlier. But what it will do is give you absolute confidence on what your repayments are going to be. And we've seen a number of customers recently deciding to fix in their homes because they almost feel that economists themselves can't get the forecast right. And with the consistent rate rises all adding up on top of the cost of living, having a loan locked in gives them real stability and understanding what their repayments are going to be in the short term. And we've talked about it in the past, it's not a one-size-fits-all approach. So it's important to speak with a mortgage broker like ourselves before you make any financial decisions to fix in, or even deciding to go variable might be a better solution for some that have plans to really pay down their loan faster, because fixed rates don't allow you to do that. So it's not a one-size-fits-all approach. It's something you need to think about. So when you are deciding to fix in, you've got to be going in it for the right reasons. For example, if you're worried about increases in your monthly repayments due to rate rises and you want stability in your mortgage repayments with the ability to budget around it, a fixed rate might be a good solution because you know what you're up for a set period of time. And remember to like, share, and subscribe to stay informed with all things property and finance. So there are our 3 tips. It does look like rates are going to go up in the short term. They might even come down. I mean, who knows? It's anyone's guess. We'd love to know what your predictions are in the comments below. Where do you think the cash rate's going to end up in 2023? Guys, as always, thanks for watching. Here at Hunter Galloway, we're a mortgage broker and deal with first homeowners right around Australia. So if you're looking for a great mortgage broker, we can help. There's no cost for their service, and you can reach out with us on our website, huntergalloway.com.au. Fill in the contact form, we'll give you a buzz, or call us directly on 1300 088 065, and we'll see you next time.